Forget about DeepSeek, forget about Powell, and honestly, let's just forget about earnings. Because markets are unchanged in the after hours, even with Microsoft trading substantially lower on weak forward guidance around AI. Meta and Tesla are technically higher, but not by a substantial margin. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY daily time frame chart. What do we see here from an overall trend perspective? Well, based on our Saturday analysis, we know that we were coming from the lowest low to the highest high, and therefore, if we can find a daily higher low, it would really solidify the trend as being up. So our base case was to look for a higher low, ideally, over this key level right here at 595.85. So let's walk through this bar by bar from Monday. Monday opens on a gap down underneath the level, underneath the daily 50 SMA, which is the blue moving average on your screen. So let's put ourselves in the shoes of sellers here. If we're an aggressive seller and we do not want this to act as a daily higher low, what do we want to see take place? We want to see a gap down, a rejection of the level, and a close underneath the opening print for a red daily bar. If we ask the question, did any of that take place? The answer, of course, is absolutely not. On the hourly chart, we'll see that we hardly spent any time underneath 595.85. It was almost instantly a counter trend rally in the upward direction. And where did we close on Monday? Right at the highs of the daily bar, and certainly back over the daily 50 SMA and over our key level at 595.85. That's strike one for the sellers, and it's a positive sort of check mark, if you will, for the bulls, defending some semblance of a daily higher low. So the base case lives on. What do we see during Tuesday's session? Well, we open on a gap up. We saw a substantial push to the downside off of the open into Monday's range. Okay, if stronger sellers are going to keep the DeepSeek gap down in play and continue to offer bearish pressure to the chart, what's the next step for sellers here? Ideally, it's price acceptance inside of Monday's range, and it's some attempt to break down and provide a bar-to-bar lower low underneath Monday's low. Did any of that take place? The answer is absolutely not. Where do we close? At the highs of the Tuesday session. There's no acceptance inside of that Monday range. And again, on the hourly chart, we'll see this as a very quick opening drive to the downside that was almost instantly bought back up. On today's session, so that's strike two. Right? For the sellers, we're continuing to manage against the base case, which says that this is likely going to act as some sort of daily higher low. From here to here, we spot a daily higher low pulling back from the highest high in the trend count. And once again, the daily trend solidifies as being up. For today's Wednesday session, we end up opening inside of range, which is fine, right? There's no problem with that. You know, we also know that it was an FOMC day. And in the intro, I purposely said, let's ignore Jerome Powell because guess what? There really wasn't enough volatility intraday to cause any substantial change on the daily time frame chart, the daily time frame read here. What do we see as the low of the day? It's actually our key level. It's the lower edge of the weekly expected move, but it's also 599.65, which comes from previous resistance in the trend count when it was once down. Remember, we had highs, lower high here, lower high here. This was a lower high in the trend count. This was an equal high in the upper wick of the green inverted hammer. Now that's acting as support. So is that a positive progression for the sellers who are trying to push prices to the downside and invalidate this as a daily higher low? Of course, the answer is, again, a resounding no. So the base case lives on, where we've managed against this acting as a daily higher low. And so far, the buyers are absolutely in control of the daily time frame chart. Now, there was a little bit of struggle. I'm not going to sort of omit this. There's a little bit of a struggle off the open today to stay over 603. And as a matter of fact, let's just take it down to the hourly time frame chart so we can see this, right? We open right a hair over the level, struggle through the morning session. Here's the JPOW volatility. Again, not much on the daily chart, but intraday, it's certainly something. But we find support here and we close sort of just a hair underneath 603. In a picture-perfect world, it would have been another close over the 603 level, but this is where I just reference back to the introduction where we said, honestly, let's forget about DeepSeek, let's forget about Jerome Powell, let's forget about earnings, because as you can see here, in the after-hours spread, it's 603.47 by 58 on the bid-ask. So Are we under 603 still? Does the market seem to be getting crushed by aggressive sellers in the after hours? Absolutely not. So what's the game plan going forward? Any open tomorrow that's over 603, providing consolidation here, is incredibly bullish, and I would honestly look for continuation in the upward direction to revisit the previous all-time high at 609. You probably want to structure some trades around the closure of the full DeepSeek gap, which is to the low of the Friday session back here. That's over 605.35, closes at 606.75. But generally speaking, just seeking the equal high on the daily time frame really preserves the uptrend coming from a higher low on the daily time frame chart. And here again is what I was referencing just moments ago, where there was hardly any time spent underneath intraday on that Monday gap down, the key level at 595.85. So the more I look at this chart and the more I evaluate it from that perspective of managing against a base case, which is setting some sort of daily high or low here, which is exactly what we talked about on Saturday, right? The more it seems to me that buyers remain in control, and we're really seeking, once again, that all-time high, the equal high on the daily time frame chart, as being a reasonable outcome. Where do we change our tone against this? It's probably if the daily chart, let's just go back here for a moment, starts finding price acceptance underneath 600s, 599.65 could be used as the exact level, but if you want to use 600 as the round figure, that's fine. If we find price acceptance underneath here, is it reasonable to potentially suggest that if this is the balance range, maybe we have a look above and fail a lower high towards the top end of the range? And if we take out these lows, is it possible that we come back down and revisit the CPI gap? That's a possibility, but that is something that has not happened yet. We have not seen a failure underneath a previous day's low, right? Ever since the week opened, we had lows, we had a higher low, and we had a higher low again today. And based on what's happening in the post-market, it appears as though there's going to be a decent opportunity for another higher low to form during tomorrow's session. So one more time on the daily time frame chart, if we're coming from here, which is now going to be classified as a daily higher low, is it logical to expect that the next move in the trend sequence would be to set some sort of equal high? I think the answer is absolutely, as we've displayed so far in today's analysis. So really looking at 609, 610.85 as potential upside targets here, which is still well within the confines as well of the weekly expected move. Let's not forget that the gap down from the DeepSeek news on Monday really put us at like a 1.5, almost 2 sigma move to the downside instantly to start the week. So some mean reversion here to the upside is totally within the confines of what the market had been pricing in from a volatility perspective to begin with, based on Friday's close of last week. So that's the daily/hourly analysis in tandem. If we take a look back at the hourly time frame chart, let me just auto zoom this for a second. I want to show you a couple of additional perspectives here with the Fibonacci's from the low to the all-time high, noting that the 38.2 wasn't great confluence with the level. We sort of talked about this as a zone on the Saturday update video, but we've pulled back towards that zone. Let's treat it as a zone, and we're holding above. So in the grand scheme of things, one more time, is it reasonable to assume or reasonable to call this some sort of higher low in the trend count from the daily perspective? I think the answer is absolutely. And we're seeking that continuation towards the equal high as we've described thus far. Let's come in here with the intraday anchored view apps as well, and we'll clean up the Fibonacci there. And the point I want to make here is just that the market's slated to open as of right now, and a lot can change between now and 9:30, I understand that. But if we're over 603, that's over the entirety of the anchored view app cluster from intraday pivots, right? Obviously, you have your big low down here, CPI gap up, all-time high, as well as the DeepSeek gap down on Monday. You're over all of those anchored view apps as of today's close. We closed right at the all-time high anchored view app for today's session. And again, the forecasted open is over 603, which puts us over the entirety of the cluster. So the more I look at the data, the more I look at the trend, the more I analyze what's happening from that sequencing perspective, the more I just lean into the base case from the daily perspective and say, yes, it seems more likely that a daily higher low is potentially holding here. And one more time, I know I've beaten this to a pulp, the target is the equal high at the all-time high. A very simple way to view this chart as well is like, hey, we've got a very simple inside bar on the Wednesday session, and it looks as though we're opening towards the highs of the inside bar for the follow-up session. If we can break out over the inside bar high, it starts to break the range, and in theory, a break to the upside should seek continuation higher. What's the obvious target? Everything that we've already discussed so far in today's episode. Let's move along to the market internals. If you're not familiar with this dashboard, take a look at the video tutorial in the top right-hand corner of your screen. What do we see here? So I do want to remove the total cumulative volume flows for just a moment, because what I want to focus on is actually the gap down from Monday and just evaluating, were there really stronger sellers getting involved on that big panic move to the downside? Well, if you take a look at the market internals here, the answer is absolutely not from a volume flows perspective, and the actual breadth ratios intraday, that's this historic read in the histogram down below, the worst breadth read throughout the day was negative 1.37. Negative 1.37 on the massive gap down from DeepSeek on Monday. So one more time, do we have stronger sellers participating in the auction to the downside there? The answer is absolutely not from a volume flow perspective. It's really isolated to NVIDIA, which opened down like 12% that morning. If we look at the advanced decline line, yeah, it opens negative, but where does it close? It closes positive. If we look at the cumulative build on the tick, yes, it's absolutely flat, and I'm not going to sit here and say that it's a bullish read, but one more time, the point is not to say that it's bullish. The point is to say that it's not bearish, and there's a big difference between those two things. So continuing to monitor this base case daily high or low makes a lot of sense given what we can see here at the exchange level. Now, Tuesday didn't really have the support at the exchange level that I would have liked to see. Tuesday was a pretty substantial rally in the upward direction, but yet we have pretty neutral volume flows. We have an advanced decline line that's flat and a cumulative build that's actually a little bit worse than the Monday session. So was it reasonable that maybe the market pulled back here a little bit to test that 60-50 off of today's session? Absolutely. And I know we talked about it briefly over on the Spider's Cash on the hourly time frame chart, but I mean, talk about a picture perfect pullback from today's session. I'll just reinforce that one more time. Previous resistance acted as support, acted as resistance. Beautiful hold as a new area of support headed into the remainder of the week. So as long as we're over that, it's 600 in the SPY cash. It's of course in the ES futures 60-50. We talk about this in the pre-market prep until we're blue in the face. If we're over those levels, I really don't see a reason to be panicked about the S&P 500 reversing this trend in the downward direction and providing more pain in the market ultimately. Let's quickly check in on the market profile and see what else we can glean from this perspective here. The main thing I would point out is just that on the Monday session, value was towards the midpoint of the range, as was the point of control. On Tuesday, one more time, put yourself in the shoes of a seller. In theory, as we open near the Monday high and see an opening drive to the downside inside of the Monday range, you would expect, if we had stronger sellers participating, to get price acceptance in here. So if we evaluate the value area on the Tuesday session, is that the case? We know this based on the price chart itself, but just displayed another way, the answer is absolutely not. Value is clean to the upside outside of the entirety of Monday's range, never mind even getting close to the Monday value area. Now, we also have a very poor high here on the Tuesday session, which is worth carrying forward in the narrative. That really would suggest that we should expect, if tested, a break of that in the upward direction, which of course does what? It triggers everything we've been talking about so far, a repair of this poor high, those 3 TPOs flat across the top, should unlock upside to seek the equal high, which is the all-time high in the S&P 500 cash, the SPY ETF. And if you're not familiar with the market profile and you want to learn more about this, check out the video tutorial in the top right-hand corner. So far, everything aligns with a little bit more of a bullish edge in the market, or at least, as we mentioned on the internals, there are no stronger sellers who are participating at this point in time. If we take a look at today's market profile, the value area is towards the upper portion of the individual session, which to me would just reinforce the idea that even with the Jerome Powell volatility at 2 and 230, stronger sellers were not able to really get price acceptance. Even if you want to use that infamous 60-50 level, we're not even close. Yeah, there's a little bit of an overshoot here towards the low of day, but value area, not even close. Point of control towards the high of day, technically a poor high up here. There's lack of material excess at the lows as well, if I zoom in, so let's not be too one-sided in the analysis. There is a poor low on today's session, but given that we have an even poorer high up here, lack of material excess at the high, and given all of the things we've talked about in today's analysis so far, a little bit more partial to the upside, as you can probably tell from all the considerations. Let's jump back on over to the platform here. Let's take a quick glance through the QQQ, see what's going on with the nasty NASDAQ. Let's give this a reset. Here it is on the daily time frame chart. So a little bit different here in the sense that, of course, we're not pulling back from the highest high, the all-time high. We've technically broken the resistance trend line, and we've talked about this, of course. And the next big pattern that everybody's going to shout from the rooftops about is maybe this sort of inverted head and shoulders, and that's great. But for now, we just want to manage against the base case. So is it possible that 510 offers a higher low? It is absolutely possible that from here to here, we produce a higher low. However, in the Saturday update video, what did we say is the issue with spotting a higher low, or I should say under 518.50? Technically, 510 can do it, but under 518.50 is dangerous here because now all of a sudden, if we get a retest of this level, I'm really more concerned about the potential for a lower high to keep us in range. Whereas the S&P is sort of coming from a more respectful place, if you will, in the trend count, right? It has the highest high in the trend count. It's the all-time high. Whereas in the NASDAQ, we don't really have all of those favorable tailwinds for us. So out of the NASDAQ, I would take a similar approach where I would say, okay, on Monday, sellers kind of failed here. They didn't really find any acceptance under 510. We didn't close at the high of day. We technically rejected the daily 50 SMA. That's fine. Tuesday makes up for that by a little bit. Of course, closing up towards the high of day over the 50 SMA, over our key level, ideally here at 518.50. And again, sellers failed today in the lower wick of the session, supporting over the 50 SMA and closing one more time over that 518.50. So for the most part, I would still be partial to this sort of idea, looking for the gap to close overhead, but I would be more willing to entertain the possibility of a short off of 528, the gap fill reversal on the QQQ, than I would be in the S&P 500. The S&P is the place to be for longs, and I'll tell you why in just a second here as well, and the NASDAQ is the place to be for shorts. The logic behind this really comes from the performance of financials. I would say that semiconductors are really treading on thin ice right now. We can quickly look at NVIDIA, not to spoil what we'll get to in just a moment, but NVIDIA's continuously just rejected this overhead supply, right? Monday on the gap down, it was the upper wick. We stopped the auction there on Tuesday. Today, we didn't even test it. So semiconductors are not helping the case for upside, which to me is one of the reasons why I've just said that the NASDAQ is the place to look for shorts and the S&P is the place to look for longs. Because if we quickly flip on over to the XLF, here it is, we can see that this chart looks phenomenal. There is no overhead supply. There's plenty of opportunity for a higher low here. We could Brigade bolt back to blue sky territories. Heck, we could even set a weekly higher low here. Boom, boom, daily 50 SMA meets us. We have 49.60 as kind of a new line in the sand-ish on the XLF. So S&P 500 looks far superior in terms of where we want to be long versus maybe where we're a little bit more open-minded to two-sided trade offering a short, which would be here in the NASDAQ 100. Let's take a look at the hourly time frame chart. Let's see what else we can glean from this movement. We'll throw on the Fibonacci's and, of course, the intraday anchored view apps to be congruent in the analysis. Notice that we way overshot the 38.2. We did technically stay above the 61.8, but we sort of spent more of our time here in no man's land between the two key fibs. If we throw on our intraday anchored view apps, and that's an illustration of relative weakness, right? If we throw on the intraday anchored view apps, notice much more of a tangled effect in here. We are technically above them as of right now, but not by a clean margin. They're not cleanly trending in the upward direction. I think you have much cleaner of a chart. Basically, the price levels are cleaner for bulls over in the S&P 500. And I would really say that the simplest illustration is just, do this. You have a daily balance range. Where did we close? Technically in the midpoint, right? Whereas the S&P has made more progress in the upward direction. Let's check in on the market internals for the NASDAQ side of things, just to make sure we're not omitting any obvious data points here. On the big gap down from Monday's open, did we have substantial volume outflows? Notice that the answer here is absolutely, and you can thank NVIDIA for that, of course, but that's a little bit more of a bearish data point for the NASDAQ, supporting our sort of bifurcated view on the two indices so far. If we think about the follow-up move here, a little bit more impressive on the inflows from Tuesday, but today, a little bit more to the downside other than, or relative to, I should say, the S&P. You can see that the advanced decline line here has been underneath the zero mark all week on the NASDAQ, getting much closer to our trend lower zone, and the cumulative build on Monday, much more severe to the downside. So one more time, I think the internals support the thesis and the narrative that we've put forth so far. Let's take a look at the nasty NASDAQ market profile and see what else we can glean from this perspective here. We do have a string of single prints, and this is sort of a mechanical-ish level, and we would just carry this forward as 21,385, give or take. So these single prints from the post of the Tuesday session are an area that could be retraced fairly quickly if tested. So we'll wait and see if that's ultimately an outcome. I would think that primary outcomes want to rely on this consolidation first. If the S&P remains bullish, we'll look for the Brigade bolt out of the inside setup, right? If we just go back over to our price charts here, that would be this exact trade we just talked about for the gap close overhead and the post of those single prints that we were just talking about to show you that on the price charts. Let's just throw this back on and get rid of those anchored view apps. That would be underneath this mechanical level right here. Basically your daily 50 SMA at 517. Let's just round off there and call it 50. 517.50. If we're underneath 517.50, probably expecting more of that rotation to 510. Keep in mind that this, of course, sets up a lower high from here to here. I would be much more open-minded to potential short scalps into 503.25, which almost brings us full circle, because if we go back to the daily time frame chart, one more thing I want to continuously just remind folks of is we've talked about the ability to have a little bit more of a short bias in the QQQ because of some of the things we've pointed out, the lack of the all-time high, the technical violation of the ideal level. But do we want to be short the NASDAQ for like an, oh my God, it's going to crash and go to zero? Basically, do we want to be short outside of anything more than a quick scalp to the downside? Probably not. And I just lean into that continued idea that as long as we're over 503.25, the weekly trend is really just forming a bull flag more so than anything else. So that's your NASDAQ analysis. Let's reset this. Let's go on over to our good friend, the Rusty Russell, via the IWM Cash ETF and see what we can glean from the daily time frame chart. Not as much panic here with the DeepSeek thing not even being a factor by any stretch of the imagination. So all set on that. Generally, I think that there is still a bearish slant to this chart, so this maybe neutralizes some of the bullish sentiment that we had over in the S&P 500, where you can clearly see multiple upper wicks Monday, Tuesday, and today's Wednesday session all rejecting that 227. The fact that price got above but could not stay above and is rejecting the daily 50 SMA is kind of a red flag to me. This, as a balance range, might just be producing a look above and fail, where of course the target always becomes the opposing end of the balance, in this case at 218. That would certainly act as a headwind for the S&P 500, which once again is a logical thing to start thinking about if we see some struggle here out of a couple of things. Firstly, the IWM small caps, that speaks for itself, headwind, as we've already said. But if financials cannot overpower any potential weakness in the tech market, or even just more specifically the semiconductor market, then that S&P bull thesis that we were just talking about, seeking the equal high, might need to turn it down just a notch or two. One more time, I would not be aggressively bearish in the S&P. I would reserve that for the NASDAQ and scalps in particular, so long as we're above 503.25. If we're under 503.25 in the NASDAQ and these other things are also bearish, semiconductors, small caps, right, financials aren't pulling their weight, then yeah, it's a different story and we're probably looking for further downside. So it's the interplay between those couple of ideas right there that really, in my opinion, drive the trade for the remainder of not only this week, but probably through the bulk of like the big earnings season, where we still have some of the Magnificent Seven names to report next week. Of course, we have Apple tomorrow after the close, Amazon, Nvidia is usually much further out. You get the idea, right? So those things are interesting to me in terms of the intermarket interplay. If we take a look at the hourly time frame chart here, you can just see that there's not a lot of acceptance, right? We got this into the end of last week, which was great, but on Monday, right, that upper wick is exactly that. We spent one hourly bar closed above, closed the next one below, then majority of the price action this week has continued to remain underneath 227. So much more of a headwind here, and this sort of is reflective of one of the conversations we had in the pre-market prep videos this week, which was just that small caps don't really buy the fact that Jerome Powell is going to bend the knee and cut rates aggressively just because the administration wants lower interest rates, right? Small caps getting underneath this 227 is probably more of a signal that we stay higher for longer on interest rates, which is kind of exactly what we got from Jerome Powell during his press conference today. Very neutral, very honestly professional in my opinion. I think it was well handled. If we take a look at this, and we'll get to the fundamentals in just a moment. If we take a look at the Fibonacci's, we are technically over the 38.2, but you're sort of caught between a rock and a hard place. I certainly would respect 227 for what it's worth and say that, the 38.2 is a nice to have, but it's not really going to overpower the bearish implication of being under the weekly pivot. If we throw on the intraday anchored VWAPs to be completely congruent, we're in the cluster, and if we break out, great, it's a positive tailwind for the S&P. If we remain tangled, it's bearish, and it's really bearish if we move underneath that 224.25, probably looking for the CPI gap to close over time. That's at 220.25. So we have some risks out there with the small caps. Let's take a look through the lens of the Russell internals. You can see that we had substantial, was it substantial? No, sorry. Not substantial, but definitely more so red than the S&P 500 on Monday. Not, again, surprising, but you would read into that just because there was no DeepSeek panic over here. It was still a bearish day out of small caps. You can see that for the most part, we have a majority of the time spent under the zero mark out of the advanced decline line, and the cumulative builds out of the tick are also red here for our Russell 2000. The futures level that we've been using is 2310, as you well know from the pre-market preps. Let's take a look at, of course, our market profile. I would just point out that the mechanical low has been repaired based on today's low of day volatility, so carry this forward as being repaired. And if we could stay over, this is maybe a small feather in the cap for the buyers right now, but if we could stay over 2283, it's possible that this represents the proper end of the auction. This remains just, neutral to bearish consolidation, but as long as this holds, as long as we're over 2283, this being the proper end would sort of indicate, I should say, that we don't need a further test. So a small step for bulls there, but not enough to change the charts outright to bullish. I think if we just go back over here, it's very, very simple. This is bearish consolidation. This is like, okay, bearish actively seeking headwinds for the S&P, even changing tone to short bias in the S&P, versus up here where, okay, things are a little bit easier going, looking for that all-time high continuation trade out of the S&P. So really 227, we've almost talked probably too much in a circle about small caps here. If you want to keep it simple, 227's been the level. No need to change that based on everything that I can see currently. Let's reset this. Let's take a look through our S&P sectors, starting with the weekly performance. Who's leading, who's losing, and where's the weight? Communications lead, up 2.92%, followed by discretionary, and then the technology sector, of course, all three of those outperforming the S&P index itself. That's bullish. If we look at the bottom end of the barrel, it's utilities, it is energy, and it is real estate. So not really seeing defensive posture. If anything, this is a risk-on signal here with the outperformance from the heavier weight risk-on sectors as the market's trying to set the DHL shipment, right? As we know, it's the daily high or low. So far, so good from a posture point of view. If we look at the structural charts here, this looks great. Equal high has been set, which means that we can afford a higher low pullback, reattempt, and we'll look for a breakout to blue sky territories. We'll reevaluate if we're underneath 99.15, but this chart doesn't really seem to pose a threat into the end of this week. Google earnings will have more of an influence over there. If we look at the XLY, keep in mind that Tesla earnings are impacting this. It is slightly higher in the after hours, but it's not yet over this 234 pivot. I would say if tomorrow we open on a gap up and we get like a gap and go, any acceptance over 234 would be a bullish influence for the S&P 500. If we're just in here, it's not bearish, it's just neutral. Bullish to neutral, I might even add, noting that we have lows and potential higher lows, building out a new uptrend. Coming from here to here, we absolutely already have a higher high. So this chart is in the process of continuing its uptrend if we can see follow through from Tesla. Let's move along to the XLK. This is where we have a little bit of a struggle, right? Microsoft, big gap down, is not really pressuring this lower as much as I would have thought. You can see in the after hours we're 231.85 by 50. Close was at 31.74. So just inside the prior day's range. Now, it's not the best looking chart. We are at the bottom end of the balance range. But if anything, what does this suggest from a risk-reward perspective? Risk, reward, back to the top end of the balance, if you're a believer that this is just a hiccup for tech and we're probably going higher over time. I don't know that I buy that right now, just based purely on what's happening with NVIDIA and that overhead supply we briefly touched on moments ago, but that's one potential idea here from a trade location perspective. I would just think that as we think about what we were doing in the S&P managing against that base case, coming from the highest high, right, because this was a brand new all-time high, it would have been ideal to set some sort of higher low over the daily 50 SMA. Did that take place? The answer is no. So can we manage against a daily higher low base case? The answer is no. We're already at an equal low towards the bottom end of the range. You can see that there's maybe a lower high even underneath the daily 50 SMA. Be a little bit more reserved in my approach here on the XLK. Now, would I love to see some consolidation and a break to close the remainder of the DeepSeek gap? I mean, absolutely. Of course, that would be bullish for the S&P 500, but objectively looking at the chart, I don't know that we necessarily have the strongest influences for the tech sector right now. If we just quickly take a look at Microsoft, unless things have dramatically changed in the after hours, which they haven't, we've got 423.55 by 424.11 in the after hours. That basically puts us down here from a close, which was up here. I mean, that's pretty substantial for your XLK. So I'm not seeing a smooth path forward for the XLK tech sector if Microsoft earnings do not rally out of the gates and keep us over this daily 200 SMA, over this 425 level. If we're underneath that, I would start thinking about highs, lower highs, give me the equal low, and if we really zoom out on the daily time frame chart, I mean, that's a pretty dangerous flush point. Underneath this huge overhead supply, Microsoft not issuing great forward guidance, hardly any share price growth over the last year or so. It's a pretty tough looking chart for investors, and that's really, you could make that conclusion just by looking at the spaghetti moving averages in here, not cleanly trending in any particular direction, and no separation between them, right? They're just tangled with one another. So back to the sectors though, let's get on over to the XLF, which looks great and is one of the reasons why I want to maintain more of that bullish stance in the S&P. We talked about it, but this looks fine. Higher low here, Brigade bolt back up through the highs. JP Morgan has been doing great. Goldman Sachs has been doing great. Generally, we'll look forward to MasterCard and Visa earnings because they're now included in the XLF, but plenty of room for a higher low. So all set with this. No issues, right? Really constructive for the S&P so far. I will change my tone about that if we start finding price acceptance underneath 49.60 as mentioned earlier. Moving along to healthcare, an impressive move in the upward direction really on the Monday, seeing a gap and go relative to the broad market, which gapped down, of course, on DeepSeek. But if we can just set a higher low one more time, we're looking for a higher time frame trend reversal here, which could change the tone. And if the XLV can actually reverse, that would be a big step in the right direction to continue to act as a tailwind, helping the S&P 500 move higher. XLP, still struggling with this level in here. It's D for defensive, so I'm not overly concerned with that. If it breaks down to close the gap down to 78, not the end of the world. Not the end of the world at all. It's technically a bearish inside bar, 3-bar play to the downside here, set up for tomorrow. So XLP can honestly be a short underneath and into the gap. Utilities, not an issue either. Looks a little bit, excuse me, looks a little bit weaker underneath this 77.50, but is it an issue for the broad market? No, it's D for defensive, it's lightweight, we're moving along. Energy continues to just offer its sine wave. I wouldn't be surprised to see continuation lower. We'll keep tabs on that, but not really going to influence the market until it makes a new swing high and breaks out of that range. Here's the XLRE real estate pulling back a little bit, not the end of the world. Still offering a potential higher low over 40.2. Just keep in mind that this is going to move with what's happening in interest rates, and interest rates have basically pulled back mildly. This is very, pull up a chart of the TLT, pull up a chart of the ZN, ZB. It's almost, I don't want to say identical, but it's fairly similar in terms of its structure. Semiconductors, here's a red flag. Here is a red flag, and we've touched on this with NVIDIA, obviously, but here's huge a huge range we've been talking about for what seems like months at this point. It really has been months. Look above and fail, look above and fail, look above and fail, and the fourth time is not the charm. Look above and fail, no high or low set above for that continuation to the upside. So it's not a terrible chart in the sense where you could say you want to be a long off of support here with very tight risk for reward back up to potentially close the gap. I can understand that from a risk reward perspective, but generally speaking, in terms of its influence over the S&P 500, there's so much failure happening on this chart where the market does not seem to want to continue pushing in the upward direction. Even beyond this, if I just put my fundamentalist hat on for a brief second here, if DeepSeek proved that you can produce models at a fraction of the cost with apparently, and we don't know how much of this is true, of course, so take this with a grain of salt. If you can make a model that is on par with the best of the best and use, older hardware or a fraction of the amount of hardware that's needed, then you have to reconsider the value proposition of maybe a company like NVIDIA or the semiconductor sector as a whole. And that's not to say that semiconductors are going away and, oh my goodness, short this thing into the ground. But it just makes sense to me that if we've seen 1, 2, 3, 4 failed breakouts, and now with the DeepSeek news, there's maybe a reconsideration about, okay, what's the true value of this stuff? Or did we overprice it in the past? Should we, sort of reduce some of the premium that we're pricing into this? Seems reasonable, right? Does not seem too out in left field based on what I can see in front of my very eyes, purely based on price action. So I'll keep an open mind. And one more time, would it be great for the S&P bull thesis if we saw a move into the DeepSeek gap? Absolutely. I'm not going to fight against that at 245. I'll look for the long if that's the case, but I'm just not convinced that it's going to be necessarily smooth sailing here for semiconductors. So a little bit of a fundamental rant tied into the technicals there. If we look at the XLI, no problem looking for a higher low here. It's a lighter weight sector, probably about 8% still of the S&P, so not an issue. If you look at materials inside of this previous range, that's a good first step. We could take a look at the XHB, which of course we've been tracking as well. The lower high here is concerning. And of course, that's on the premise that rates will remain higher for longer. Jerome Powell basically said today, we get it that prices have been elevated, but the pace of price increases continuing is slowing down. And that's inflation, right? Technically, prices will not come down. They will just not get more expensive at a rapid pace like what we've seen in the past. So just this readjustment to the higher prices without interest rates coming down, because Powell was pretty clear about, no, we're not in a rush to cut rates. Not a shock to see home builders move in the downward direction. So a little bit of a hit here to the cyclical side of the economy. TLT sort of ties into this narrative as well, where a little bit of a down day here, individual in terms of its sole day out of the TLT, but generally higher, sorry for the auto zoom there, higher from the lows off of the gap close down here, which honestly we gapped the gap, so it still exists to some degree. Anyhow, I'll keep you updated on the short strike 85 puts. They're basically going to expire worthless at this point now that the FOMC is in the rearview mirror. I'm probably going to look to take those off tomorrow morning for pennies, right? If I could close them out for 5 cents, if I could close them out for 10 cents, that's great. I'd rather not wait around for the extra $100. I'd rather free up the margin. So just as an FYI, one more time, if I ever have a swing position on, I'll be transparent about the state of it. So that is that. TLT accomplished. Let's take a look through the ratio charts and see what's going on from this perspective. Sorry, misclick there. Here it is. If you're not familiar with the ratios, check out the video tutorial in the top right-hand corner. Some concerns over here, which is the conversation we've been having about maybe semiconductor dominance not coming to an end, but just not certainly not rallying or trending the way it was in the past. Financials look great, which is the supporting thesis for the bulls over in the S&P 500. Discretionary looks good. Tesla's probably going to open on a gap up tomorrow as well. Communications look good. No flight to safety here. No flight to safety here. And the XLV, yeah, it's technically starting to put in some sort of higher high, maybe a higher low here. We'll keep an eye on it, but it's not directly a risk-off signal just yet. And we can see this more specifically if we look at this dashboard here, where again the tech stuff is a little bit more concerning with some of these more sideways moves instead of sustaining some progress in the upward direction via higher lows, via some sort of higher low up here. So a little bit more neutral there. But if we look at pure risk on versus risk off, I mean discretionary versus staples, it's about as apples to apples as you can get. We're still more in an uptrend here, which is indicative of risk appetite remaining strong. Semiconductors got decimated, so one more time, not a shock to see this break to the downside. But generally speaking, somewhat of a neutral risk stance, small edge still to the bulls from that perspective. The yen carry trade is a non-issue. Anybody who is telling you on Monday that the gap down was caused by the yen carry trade just has no idea. Let's take a look at the Dixie and see what's happening over here. A little bit of a pullback. Not much to really comment on other than the trend remains intact to the upside on the breakout of this long-standing balance range. If we take a look at interest rates, let's bring up this one down here. We know that this is inverse basically to the TLT, where you have your head and shoulders. Rates slightly higher today, but even with Jerome Powell adjusting the Fed's statement to, in my view, being a little bit more hawkish, he did a good job of keeping the press conference and the Q&A primarily much more neutral. So small uptick, but nowhere near the highs from back over here, even though we know that we're basically in store for higher for longer. Let's take a look at gold relative to the dollar, gold relative to the S&P to see if there's a flight to safety. I mean, it's over the key level that we've been tracking, right? We've been using previous pivot high, pivot high, pivot high, now support. We've been using that, but is it really indicative of a flight to safety? No. I mean, you're not seeing like, oh my God, let's go out and buy gold because Powell's admitted that inflation's out of control and things are about to get wild. It's just not the case, right? And gold is even just sideways over the last couple of sessions in here. If we look at the inverted ZT as a proxy for the 2-year, it's backed off slightly from these highs. So the rate hike discussion is probably off the table, and we could even just, put that to bed if we take a look at this. The odds of any particular rate hike into the end of the year, just non-existent through this column over here. We'll see where the rate cut gets priced in most aggressively. Let's actually give this a refresh, see if it's updated in the after hours. Yeah, we're still sitting here around the June timeframe for the first rate cut and one into the back half, the very end actually, of 2025. So 2 rate cuts still being priced in, even though Jerome Powell was pretty adamant today about saying, hey, we're not really in a rush to cut rates by any stretch of the imagination. And you can even see what I was referring to as the hawkish adjustment, I would think, in the statement tracker, and it really comes from the very first paragraph. And Jerome Powell sort of tried to shrug this off in the press conference by saying, we were just we were adjusting it because we didn't want to have this prior statement in here. It was just like, okay, enough about that. Just own up to it and say for what it is, right? The unemployment rate has stabilized at a low level in recent months and labor market conditions remain solid. Inflation remains somewhat elevated, right? Rather than inflation has made progress towards the committee's 2% objective. Instead of saying that there's progress, they've taken that out and they're just saying inflation remains somewhat elevated. Again, he tried to shrug it off and say, we were trying to play with the wording in there. To me, it was a hawkish adjustment. So anyhow, that's really the major change out of the statement there. But as we know from the tracker tool, and if you watched the press conference, right, it was very, very well done, I would say. I'm actually quite, I wouldn't say proud, but thrilled with the way Jerome Powell handled himself, not bending the knee and sort of ruining Fed independence and Fed credibility, but also I was somewhat nervous that he was going to take a counter jab at the administration and say, take much more of a hawkish stance and say, like, these guys are crazy. Why are they demanding lower interest rates? It's not even a consideration right now. We're actually thinking about hiking interest rates. He didn't take that counter jab at the administration, even though obviously, and you could just see this in the headlines, Trump is not fond of the man. He didn't, play back or fight back in jest. He just sort of swallowed that pride, didn't comment on any of the political turmoil, if you will, which I think was a good thing. From a Fed perspective, from a market volatility perspective, from a Fed independence perspective, I think it was a good thing. So regardless of how you feel politically, for the market, he made the right call. So pretty thrilled about that. Let's move along here. Obviously, into the remainder of the week, we'll watch unemployment claims from a economic calendar perspective, and PCE will be a big deal on Friday morning, 8:30. Come out to the penthouse. We'll have coffee and donuts. We'll watch the market's reaction live, and we'll sort of break down the report and see if Jerome Powell has anything to worry about or if he should maintain his stance, right? And say, okay, we just want to make sure that this continues to work its way towards 2% earnings calendar. Not a shocker over here, of course, the big deal, as we've already mentioned, Tesla, Meta, Microsoft. Microsoft, technically, forward guidance looking pretty rough there on the, specifically it was Azure and intelligent platforms or intelligent cloud, segment was not great when it comes to a guidance perspective. Meta, Zuckerberg pounding the table for more AI infrastructure spend and also talking about, hey, our Llama models are open source, as we've seen from DeepSeek. This is probably the right way into the future, and we're sort of leading that for America. Tesla, Elon Musk with the off-the-cuff statement saying, hey, Tesla is probably going to be the most valuable company on the earth by an order of magnitude way larger than the next 5 companies combined, right? You can go listen to the earnings call. Kind of an insane thing to say during the press conference, but that's what we got. MasterCard reports before the open tomorrow. Visa will move in sympathy to that. I'm sure Apple after the close will be influential as well. Of course, next week we have Amazon and Google, which we'll keep close eyes out for. Here are the headlines just to give you a little idea. Meta once again beats on revenue, soft guidance going forward, but more about the AI infrastructure. Microsoft shares slip on light quarterly Azure growth and the guidance going forward, more importantly. And Tesla, this one's a little bit perplexing to me. I mean, it was just a miss across the board. Not really a great look there, but Elon Musk through the conference call able to sort of rally the troops behind him and say, hey, our autonomous vehicles, full self-driving, the robot who Optimus, there we go, is going to be like out of this world, and it's just going to be completely game-changing. And he was really hyping up 2026, 2027. We're setting ourselves up for success. We'll see what comes of it, but he usually talks a big game, and we'll see if the market sort of corrects him on that as we move forward. Let's take a look at the remainder of the risk appetite sort of sentiment gauges, if you will. TLT ratio to the S&P, small counter trend move in here, but nothing substantial where I would say it's a flight to safety concern just yet. If we look at bonds relative to themselves, trying to set these lower highs is important, but once again, remember that the next key step is breaking the 50 SMA. In all of these instances, we're not there yet. The market still seems to be somewhat concerned about inflation. I would say the PCE report on Friday probably will have our answer here as to whether or not these roll over or if they stay in their uptrends and continue to offer a little bit of an issue. Let's take a look at credit spreads. Now that the FOMC is in the rearview mirror, I would probably think that these start to settle down a little bit more aggressively, perhaps. Not the case out of LQD, which is the corporate grade side. Junk bond side and the shorter duration is a little bit better. So not really seeing a flight to safety here, or not really seeing a suppressed risk appetite. If these were in like really aggressive, strong uptrends, I'd be more concerned, but we just don't have that yet. If we take a look at the HYG, and when I say yet, I shouldn't really imply that we are going to get it. The chart currently is just, it's a non-issue from a risk appetite perspective. HYG looks good relative to the amount of volatility, that we've seen in the S&P 500. If we take a look at, let's go into this menu. Bitcoin, digital gold looks good as well, holding up near those highs. We did technically see a bearish signal here on the Saylor Shift ratio, but that doesn't really imply a bearish move until we take out the last swing low. So all set from that perspective, I would still argue that the bullish indication is still risk on, and this even has the potential of turning off if we can get a little bit more of a rally here into the end of the week. So we'll keep you posted on Saturday as to how that closes. Total breadth is subtle improvements, continuing to stay over the 50% mark, at least avoiding the situation that we can compare to back here. Remember that the 50 SMA, the blue moving average line on the screens here, was setting a counter trend lower high underneath the 200 SMA, the green, was underneath the 50% mark as well. That's just not the case, and it's not the case over here as well. We're still over the zero mark out of new highs versus lows. If we use the RSP as a simple way, a proxy, if you will, for this, that entire screen, it's the same concept here. This is still very bullish for the S&P 500. QQQE, same concept. Actually, a little bit more so in play right here, right now, just holding the top end of the balance range. If we come in here with industrials versus transports, this probably speaks more so to the weakness we're seeing out of IWM. So 17,000, still a key watch out of transports. If we're below, a little bit less of a risk appetite than we'd ideally see for continuation to new record highs in the S&P. VIX is settling down, not a shock there. One thing I would point out here is just that relative to the Powell plunge back here, we did not see an equal high. We did not see a higher high when it comes to the VIX. So were market participants overly fearful of this gap down in aggregate? I would say no, and we saw this reflected in the market internals as well. Market internals on Monday for the NYSE exchange in particular were not overly bearish, right? So that makes sense. If we look at the VVIX, this also did not take out the Powell plunge high. And if we take a look over here, what I find most compelling about the volatility futures is that although there was, let me just maximize this one. This has been our go-to chart over here for volatility, right? Although there was that big downside move, yes, the front months sort of came in aggressively, but did any of these relationships invert? The answer is no. None of them went under zero, obviously, but we did not see this line take out this line, or this line take out this line, right? It just didn't happen. There was no inversion through the volatility curve. And in my view, that really is more of a bullish thing, which supports the idea that our base case here, just to bring it full circle one more time, is that the daily higher low can persist. We're all set here at 595.85. Now, again, keep an open mind, but so far, I would say through all of the data points we've seen so far today, there's still more of a bullish edge in this market, seeking the base case to remain as a higher low in search of an equal high. Let's take a quick tour through the core list of companies and we'll see what's going on here with those additional 3 ideas. NVIDIA, we've told you about this issue. We've told you about this overhead supply. If you have not seen our clip over on X about the weekly issue as well, if we come in from the weekly perspective, right, everybody's saying, hey, look at the trend line, look at the hammer candle, look at the weekly 50 SMA. I get it. There might be something to that, and maybe this is a generational low. But from a trend follower's perspective, I would just remind you, the trend line's one thing, but it's just a forecast of where maybe some buyers might step up. If you're actually counting trend, you have lows, higher lows, higher lows, higher lows. Remember that to form a higher low, you need a daily downtrend. Did we have a daily downtrend here? The answer is yes. So this, of course, becomes the next higher low in the trend count. And we can clearly see that we made it back to the equal high. We did not make a higher high. And this now indicates a failure, a lower low on the weekly trend count coming from an equal high instead of a higher high. So the more I think about this, I really am a firm believer that until 129 is recaptured, you might want to be a little cautious of NVIDIA. And, I'm not calling doom and gloom. I'm not calling for zero. I'm not calling for the weekly 200 SMA. It's just a drawing, right, with that arrow. But all I'm saying is, like, everybody's gone out there and bought this dip with both hands. Maybe I'm the one who's proven wrong in hindsight, but given what we can see in the DeepSeek conversation we've had, and maybe less reliance on as many GPUs to train an equally as capable model, I think there's a compelling argument to at least be cautious if price is underneath 129, right? A lot of victory laps out there with the Tuesday session back to the upside, but that smile was quickly wiped off of a lot of faces with today's move to the downside, and even in the after hours, not really performing as well as something like Tesla gapping up or Meta gapping up, right? So anyhow, that's a quick little commentary on NVIDIA and the state of the daily time frame chart being underneath 129, overhead supply. I'd love to, this would be a great trade. Don't get it twisted. I will be participating in this to this if it wants to unfold, but am I massively speculating about, being long here for this to take place? No, I'd rather just wait patiently for this on an intraday. And if I have to miss it because it gaps up to like here or here, then so be it. I'm willing to eat the opportunity cost versus get aggressive with a ton of overhead supply. Maybe I've just rambled on about this for too long because I'm coping about it. Say whatever you want in the comment section, but from a level-headed approach perspective, those are my thoughts. Mission accomplished. Let's move along to Microsoft. We have earnings after the close. They're already out, obviously. We've talked about them. We know we're opening down here. I think that this is a struggle for the XLK. I think any lower highs underneath 425 set up the equal high, as we've mentioned. If we rally to over 425, maybe acceptance, but I don't really see this as a clean chart to participate in. I was really, really hopeful that maybe Microsoft would suggest to us, like, hey, earnings gaps us up here or gaps us down here, and we have a cleaner trend that develops. I mean, come on. Really? Really? You couldn't have given us a gift outside of this trading range? So we're still stuck in the midpoint, not really thrilled with that. Apple earnings after the close on Thursday means that IV over here is going to be off the hook, so I'm not really interested in trading Apple. So there's only a select few things that I'm really interested in into the end of the week, one of them being Amazon. Earnings are obviously next week, so a non-issue for the weeklies. And primarily, the idea is just this, right? This is your classic Brigade bolt, high or low, over this previous breakout level. I mean, this thing has been an absolute monster. So 235.25, if we can support above, looking for longs back to the equal high, if not just Brigade bolts, into blue sky territories. If we fall underneath, I'll be a little bit more open-minded to neutrality here, but I would not be shorting Amazon aggressively. That's one stance I will maintain out of this name. Let's move along to Google. Earnings next week. I'm really disappointed that Google didn't set up because of the fact that earnings were out next week. It would have been nice to have something to do over here, but just taking the chart for what it's worth. It's still a balance range here. Missed a sort of trade on Monday on the possible lower high there. It just is what it is. I don't really see the opportunity here in Google. And you can, if you're seeing a Google setup, let me know down below in the comments section, but I don't really see the idea. I wouldn't want to be long for this because you're just running right into overhead supply. I would probably want to wait for this for upside. Does that happen over Thursday and Friday? I think you're asking a little bit much, right? We are technically opening on a gap up, or at least it's implied right now it's a gap up. 198s, so that's somewhere in here. Is that maybe in store for tomorrow? I don't know about Thursday. Maybe if it's a 2-day move, consolidation here, or a gap fill reversal gets interesting. So we can entertain those possibilities. But Google really, the best trades on this thing will come from an exit of this range here. Let's move along. Metaverse, excuse me, we'll let earnings simmer off the open, but for now, it's just opening on a massive gap up, blue sky territory. So gap rules in play, opening at 693, 694. Gap fill reversal is a potential idea. I would not just blindly be short this or long this out of the gates. If you've been long, if you're holding swing longs with far dated expirations, then kudos to you. But for us day traders, it's really all about, gap fill reversal as a possible setup. Something like this with risk reward back up to the high of day. If it falls back down into range, I'd be neutral. I don't think that it's really a short in here until it turns this into overhead supply, which would require this lower high, and then maybe this turns into like head and shoulders in hindsight, right? So we're not there yet, but one step at a time. Tesla, what do we have in Tessie? The gap up is bringing us to about 405. So right around in here, still underneath the neckline of the head and shoulders from this hourly. I don't know. It's sort of caught between a rock and a hard place. There's really not much to do between 410.25 and 400. Reason being is if this is going to be a double bottom and we open over the neckline, but we're also opening underneath the neckline of the head and shoulders, you can see the dilemma. It's like, what happens in here? Who has control? The daily chart's definitely not trending cleanly. I mean, maybe you could start making the argument that this is a big time lower high. I would have already argued that from here to here, right? The double top neckline, we've been back underneath that for a little while at 415. So I don't really like a lot of charts right now do not strike me as being great intraday opportunities relative to recent levels and ranges that have built out. I think Amazon has been what's paid over the last little bit, but outside of that, it's been kind of tricky to find those intraday opportunities in some of these names. JP Morgan, what do we have at a banks? Little inverted hammer on today's session, look above and fail, closing back down inside of this range. Wouldn't be shocked to see a pullback. I mean, this chart's not going to move in a straight line forever. You could use Goldman Sachs as well. We've been talking about this one a little bit more so on the channel, at least in the pre-market prep. Look above and fail. There's a little bit more clean back inside the midpoint of that range. So like these things can pull back and it's A-okay. And keep in mind that we've welcomed for the S&P 500 pullbacks in the XLF. This is probably how we achieve that, right? So thinking about JP Morgan and XLF from that perspective, GS as well. And here is last but not least, Netflix. Nothing to do but wait for this balance range to resolve. We all know that the current history, and I've talked about it for the last couple of weeks in a row, let's just wait patiently and see if it wants to unfold like it has in the past. There's nothing saying it has to do that, but that's the general pattern that we've seen over the last, 6 earnings cycles. Let's move into these additional ideas. The first one, ADBE, so Adobe. What do we see over here? This actually reminds me of the TLT in some weird way, but inverted head and shoulders, right? So if we can break the neckline, and it might be a resistance trend line like this, it might be, I personally prefer the horizontal zones. I'm a little bit more open-minded to this taking place being a potential outcome, right? So I want to participate in that trade over 451. If I can spot that setup, that's kind of where I'm interested in looking for the long, right? You can see the thin structure retracement back from over here, the breach of all these equal highs. So it's sort of an in-progress setup where I'd like to see some more consolidation here, then a Brigade bolt above. If we get a strong opening drive, let's just say that for some reason Microsoft comes out and says like, hey guys, AI is fine and we're actually going to, we're going to revise our forecast, our guidance going forward. Adobe sort of rallies on the premise that maybe this is also related to AI. Adobe's in that realm. If we can get this, maybe it happens on Thursday, but in my view, it's probably a setup worth keeping on a watch list for the next couple of days. So that's Adobe. 451 is your key level, and the break level to target is at 471.50. Let's go back to daily charts here, and the next one is FTNT. Oops, TNT there. Come on, spelling. Fortinet. And this, of course, is cyber. And look at this big shelf. I mean, come on. What else do you want? You've got a beautiful 3-bar play on the daily time frame chart. Inside hammer, upper third of the previous day's range. Big flat highs, equal highs. Over 101 is blue sky territory. So very interested in FTNT, Fortinet here into the near-term future. I mean, you could take a look at the hourly time frame chart as well. There's not much to really emphasize here other than maybe a continued hold of 98.25 is really ideal for continuation out of this setup. If we can consolidate here, it's nothing more than an hourly bull flag, and we'll look for that blue sky break up and over 101. That is FTNT. Next up, we have our final CRWD CrowdStrike. What's going on with Crowd? It's, similar in terms of the space, but take a look at the inside bar and the blue sky territories that exist up and over 411. Nothing but smooth sailing up and over that level, and your ideal consolidation is over the previous pivot high at 387 flat. So far, so good, and that is going to conclude today's episode of the Midweek Market Update. If you enjoyed this episode, if you learned something new, if you have an opposing fundamental take on the DeepSeek stuff, if you have an opposing take on the daily trends, if you have an opposing take on anything, if you have a take that's in alignment, let me know in the comments section. It's always fun to chat with you guys down there. I wish you a green trading week for the remainder. We'll hope to see you in the pre-market prep up at the Penthouse bright and early, 8 o'clock Eastern time. Remember, PCE on Friday. We will have coffee and donuts in the office, so come hang out. It's been a pleasure. Have a green trading week, and I will see you in the next one.